All right. So what's wrong with private credit? It's definitely in the news all the time today. Private credit for a long time could do no wrong. For the last 5 years, all the headlines about private credit were positive. Double-digit returns, low default rates, easy money. You can make money, you can make double-digit returns in almost any private credit strategy you went into over the last 5 or 10 years. For a long time, it seemed like a free lunch. So what's going on in the space, and what has changed, and why are investors worried? I think we've all seen the headlines over the last year. Just like the earlier panel talked about the media building up industries, the media certainly built up private credit, and they've spent the last year certainly tearing it down. We've seen negative headlines almost every week, in fact, in many cases daily, in all the financial press about private credit. So what are people worried about? What is the press worried about? What are investors worried about? What is going on in private credit? Before we talk about some of the specific challenges in private credit, and we will get into some of those, I think it's important to actually talk about what private credit is. As was alluded to on the panel earlier, private credit is a pretty broad definition. Private credit just means some type of a lending strategy involving making a loan that's done by a non-bank. Any non-bank loan can be considered a private credit loan. That's a pretty big definition. That can involve anything from what I do, which is making loans to small tech companies globally, which is considered a niche strategy in private credit, to some of the more mainstream strategies. Let's talk about what some of the more mainstream strategies are in private credit. And these are a lot of times when you see the headlines and you see some of the negative news, a lot of it's referring to these strategies. And they tend to be 3 areas. They tend to be direct lending. And direct lending is lending to small companies, SMEs. And this was traditionally done by banks. So this was the area where you'd go down to your bank manager and you'd borrow some money for your small, medium-sized business. Increasingly, since the GFC, banks have done less of that type of lending, and more of it's been done by private credit funds. The other area that's where a lot of dollars have gone to private credit is funding sponsored buyout transactions. So these are private equity transactions where private equity firms are buying companies and they're looking to private credit to provide the debt financing to fund those transactions. That's where we've seen huge growth. And then the third area, which many of you would be familiar with in Australia, because this is where most of the private credit has gone in this country, has been into real estate. So different types of real estate lending strategies, whether that's lending money to buy a building, an office building or commercial building, or it could be lending to a developer. We've seen a lot of developer real estate financing. So when we talk about private credit, usually the press is talking about one of those 3 areas, but it could be all kinds of other niche areas like where we play in tech lending. It could be a niche area like asset-backed finance. It could be providing distressed debt investing. All of that's private credit. The point is, it's really important to figure out as an investor what you're actually investing in, because all of those strategies have very different risk reward and all of them have very different liquidity expectations. So just saying private credit, you really need to dig in deep and understand the risk reward of the individual strategy. So what are most people worried about right now? I think there's a few things going on. We haven't actually seen a huge number of defaults yet. We've had a few notable defaults and the press has written about those. Some of those have actually been frauds and maybe a few idiosyncratic situations, but we haven't seen widespread defaults yet. So why are people so concerned, and why are investors and commentators really concerned about private credit generally? I think there's really 2 areas. One is, I think what we've seen is too much capital flooding into the space. So private credit in some ways has been a victim of its own success. The industry's grown incredibly well. This is over a $2 trillion industry now. This is an industry that before the GFC was a niche itself as an entire industry, and now is over $2 trillion. So it's grown dramatically, but what's happened is a lot of private credit fund managers have grown very large, and they've been able to raise large amounts of money. And I think what's happened in the last 5 years is too much capital has been chasing too few good investment opportunities. And investors are starting to wake up to this, and they're starting to see a few early defaults, and they're wondering there's probably going to be more defaults. Because anytime you have too much capital come into an industry and you don't have enough good investment opportunities, the capital still gets put to work. And I think people are a bit concerned about maybe how some of that capital has been put to work in private credit over the last few years. The other challenge in private credit has been increasingly private credit managers have offered investors more vehicles that offer easy liquidity. So these are evergreen funds or semi-liquid funds. And there's nothing wrong inherently with offering investors liquidity every month or every quarter. The challenge comes when you're making illiquid loans that can't be sold or liquidated quickly enough to meet the amount of redemptions that you have from investors. And so I think investors in the last few years have really thought they could go into private credit and they could get their money back anytime they want. And for a few years, that was the case. You could always redeem your money and get some of your investment back or all your investment back. Now, the reason for that is because there was plenty of new money pouring in that would make those redemptions. But now that sentiment has changed, you've seen funds have to lock up their funds, put up the gates, as we say in the industry, and halt investor redemptions. So now investors are worried about maybe more defaults coming, plus maybe we can't get all of our money back. This slide just shows the increase in evergreen and semi-liquid funds. They've almost doubled in AUM over the last 2 years. And the reason they've doubled is private equity investment managers have increasingly started to target the wealth space, the high net worth space, and the family office space. And usually those investors want at least the ability to have liquidity. And so they've created these vehicles for those investors. And that's why we've seen this part of the market take off so much. But now people are realizing that they may not be able to get their money out when they expect it. So what's happened in the last year since we saw the first of the few cockroaches show up in private credit, the first few big defaults that have been widely reported on? Well, one thing is investors have started to question some of the value of the loans in the loan books that private credit fund managers have. And the reason for that is we've had a few situations where private credit fund managers have been holding their loans at par right up until a company goes bankrupt. So they're saying a loan is worth 100 cents on the dollar, and then a week later the company goes bankrupt and they write the loan down to zero or write the loan down very far. And so what that has caused is investors now have a mistrust of the marks that private credit fund managers have on their books. In fact, ASIC has started to look at this, and they've started to make some noise about requiring third parties to start to look at valuing loan books. But investors have started to get a little bit worried that maybe some defaults are being hidden in private credit portfolios. The other thing that's concerning is terms. If you look at some of the more mainstream private credit strategies that have seen large amounts of dollars go into them over the last 5 years, they've had to change some of the terms that they would normally accept. And they've had to, in effect, loosen their terms. They've had to loosen covenants. They've had to take less security. They've also provided more leverage than they probably should have in a few situations. So I think there's concern that even though we haven't seen the defaults show up yet, that investors have competed in some of the more competitive parts of private credit. They've competed to put assets out the door, because when you raise a lot of money, you're not going to give it back to investors. That's fee earning income. And most people, if they raise too much money, they're going to find a way to put that money to work. And I think that has happened. And the last thing is track record. We've had a really benign credit period since the global financial crisis. We have had few defaults. We've had low interest rates, a good economy. That started to reverse itself a little bit in the last year. And I think investors are worried that maybe private credit managers have taken too much risk in the last few years, especially in some of the more competitive parts of the market. And what does that look like with managers that have never been through a downturn before? Again, most of these funds have been started post-GFC. Most of them have had most of their growth in the last 10 years. What's that going to look like? So that's something that investors have on their mind. The last thing I'll focus on here, and I think this is underappreciated, is the role of duration in private credit. So if you have long duration, if you're making long-term loans, which a lot of private credit funds are making 5 to 7 year loans, if you're making long-term loans and you've got a really long duration portfolio, plus you overlay that you've been loosening up your covenants, taking less security, maybe lending a little bit too much money because you needed to win that deal, you really needed to compete. That is a recipe, I think, for a problem when we do eventually have a credit cycle, which I think we might be going into. And you contrast that with what we do at PFG, which is a much shorter duration strategy. You know, our average duration is about 22 months. And what that allows you to do is you can re-underwrite your portfolio every year and a half or two. You're constantly able to change and adapt to the macro environment. You're not sitting out there for 5 years with the hope that things are going to be okay. 5 years is a long time. A lot of things can change from a macro perspective. A lot of things can change with a company. And so you just have a lot more risk. And I think investors don't often think about the duration in a private credit portfolio when they're looking to put money to work. So what's wrong with private credit? Nothing inherently. I think private credit is actually a great place to invest. You just really need to know what you're doing. Private credit can offer a strong ability to achieve high income and high returns. It also offers a lot of diversification for investors. I think the challenge for investors is to make sure you understand what kind of private credit you have in your portfolio. Really dig into the specifics. The specifics matter. And again, there's lots of flavors of ice cream in private credit. They've all got different risk reward. They've all got different pros and cons to them. You really need to dig into the specific strategy and understand the risk you're taking, and also understand the liquidity parameters around the fund that you're investing in. Thank you.